The Chinese, the Russians, the way they're buying physical gold, and the way they're saying that they want to run their exchanges as a physical exchange, not a manipulative paper market, is encouraging. I mean, we've seen in the last few months that the Shanghai price for gold, the premium has been above $100 at some points. I remember beginning of October, towards the end of September, there was over $100 premium. And then all of a sudden, the Western or LBMA COMEX price had to catch up. So there is that. I think, though, as well, even if the paper manipulation scheme doesn't end, eventually the bankers, as I said, will have to the gold price go higher.
MarioInnecco, the host of the Manco 64 YouTube channel, takes center stage as he unravels the historical tapestry of gold and silver manipulation. Offering insights into significant players in the game, Innecco provides a nuanced view of what it would take to halt the ongoing charade. Schiff, a prominent figure in the financial world, noted interventions in the Treasury market, raising the possibility of a similar approach in suppressing gold prices. While Schiff doesn't perceive it as an organized conspiracy, he highlighted the government's interest in preventing a surge in gold prices. Innecco delves into the global perspective, emphasizing the contrasting approaches of China and Russia. These nations prioritize physical gold exchanges, challenging the manipulative paper market prevalent in the West. China's notable increase in gold reserves, reaching 2,226 tons by November, further underscores the strategy divergence. Despite acknowledging potential challenges, Innecco stresses the importance of patience in navigating the precious metals landscape. He underscores the enduring nature of gold and silver investments, reinforcing that their value unfolds over the long term. As the curtain rises in 2024, precious metals face a tumultuous start. The Federal Reserve's stance on interest rate cuts becomes a focal concern. Bouncing off the 100 handles, the dollar index's resilience marks a notable beginning, echoing the best start in nearly 2 decades. How might this global perspective reshape the future landscape of precious metals trading? And what could be the potential repercussions for traditional market players? What are your thoughts on this? Before you watch MarioInnecco's interview, subscribe to our channel and give this video a big thumbs up.
A lot of people think the regulators like the SEC or the CFTC, who regulate the futures exchanges, are there to help the retail public, but no, they're in bed with the big banks, the bullion banks, and we saw back in 1980 that if you try to take delivery of silver, which is part of the contract, it says you can take delivery. You know, they'll change the game and they'll stop that. And I'm talking here about the Hunt brothers, and maybe they got a bit greedy, but they started taking delivery of silver in the early 70s. So it wasn't just in 1980. As for the silver squeeze, I think that is the best way to really go after the paper game, because it's very hard to stop people, you know, you or me or other people, from buying a little bit of physical silver every week or every month. And eventually it will make a difference. It won't be, you know, as quick maybe as the Hunt brothers in 1980. What about them losing control of this scheme? Well, I think, you know, the Chinese and the Russians, the way they're buying physical gold, and the way they're saying that they want to run their exchanges as a physical exchange, not a manipulative paper market, is encouraging. I mean, we've seen in the last few months that the Shanghai price for gold, the premium has been above $100 at some points. And I remember beginning of October, towards the end of September, there was over $100 premium. And then all of a sudden, the Western or LBMA COMEX price had to catch up. So there is that. I think, though, as well, even if the paper manipulation scheme doesn't end, eventually the bankers, as I said, will have to let the gold price go higher. They will make money on that leg as well. But I don't know what could cause a force majeure, you know, something that I don't think they would keep COMEX open or the LBMA open. I think they would shut the market. It could be anything. It could be a natural disaster somewhere. It could be a start of a war. It could be a cyber pandemic, anything. But after that, prices will be multiple or a lot higher than they are right now. To give you an example, though, yeah, patience, I think, is required because when I started looking at gold in 2002, I bought my first coins. They were 220 pounds an ounce, and now we're over 1,600. Yes, it's taken 20 years or so, but I think that's the other thing that gold and silver should teach you is that they're not speculative, like Bitcoin or tech stocks. They're real money. And the best part of gold and silver is that their money system that we're in, this fiat currency system that always inflates, the currency, it acts as an investment because it protects you. And you just have to look at the report card that in Gold We Trust, the guys in, I think, in Liechtenstein, gold has averaged 9% per annum since the year 2000 in all the major currencies, the dollar included.
Innecco provides a detailed account of the Hunt brothers episode, highlighting that by 1980, the price of silver surged dramatically from $7 to $50. This significant spike raised concerns within the government, signaling potential issues with the dollar's strength. The aftermath, known as Silver Thursday, unfolded as the Hunt brothers attempted to dominate the silver market. However, their strategy backfired, forcing the sale of their silver holdings at a substantial loss. The Hunt brothers found themselves unable to settle the debts incurred from their unsuccessful bet. At the peak, estimates suggested they had amassed billions of dollars in positions, controlling approximately 1/3 of the world's silver supply. Innecco's cautious advice strongly emphasizes that for a safer approach, it's advisable to invest in physical gold and silver rather than navigating the complexities of market trading. He underscores the potential pitfalls of market trading and advocates for a more straightforward and secure investment strategy. Investors often view gold as a haven. This sentiment is supported by the metal's attractiveness in recent years, especially during heightened global geopolitical risks, such as conflicts in Ukraine and the Middle East. Let's get back to the interview.
Silver futures and taking delivery after August 15th, 1971, because Nixon took the dollar, off gold internationally. And they knew they weren't silly. I mean, their father built a great oil fortune, and that's how they had their money. They knew that inflation would come and that they needed to protect all their income in dollars from selling oil. So they couldn't buy gold because it took until 1975 for gold to become legal again. So they got into silver, which was legal, and they took a lot of delivery and they shipped a lot of the physical gold by plane to Switzerland. So they were doing that throughout the 70s. And then I think they got a little bit too greedy, and they got supposedly other countries involved, especially like Arab countries got involved, and they started buying silver. There are rumors that the Shah of Iran got involved, and maybe that's one of the reasons why he was deposed in 1979. It could have been orchestrated by the CIA. You never know. And then silver, was up until the mid 70s, late 70s, the high had been $7. And then all of a sudden, in the last few months of 79 and January of 1980, it spiked to 50. And they were taking a lot of deliveries. So, and the Fed was trying to save the dollar, because when silver goes up like that, it means the dollar, ultimately that the dollar is no good. So Volcker let rates go to 20%. And he actually, it was the regulators, the CFTC, the Fed, and the Treasury, they had to gang up and change the rules of the COMEX. So I think one day they came out and said you couldn't go long anymore of COMEX silver. You could only go long to close a short position. And the market fell out of bed. The Hunt brothers had, they had leveraged themselves because the trade was going well, and that did them in. And I mean, even Jim Sinclair, who passed away a few months ago, said that he was hired. He was asked to help with liquidating the Hunt brothers position by the Fed and the Treasury. So yeah, they changed the game. I mean, and you can see the bias at the CFTC whenever silver and gold start going up a little bit quicker. They raise margins, so that the small longs can't stay there anymore because they don't have any more money to put up. But when gold and silver get trashed, you don't see them really raising margins. Keep the public away, keep it going down, and create the volatility as well. So that's what happened in the 80s. And and that's why I tell people, even though I did trade the futures market back in around 2005 to 2008 a little bit, I tell people, yeah, you can trade the futures, but beware that you can be burnt really easily, and you got to follow it, 24/7 almost. But yeah, the best way really to defeat this game is to buy physical gold and silver. It's the only way.
In the aftermath of the Hunt brothers saga, Innecco advocates for the safety of physical gold and silver investments. How do you view this advice in the context of the complexities of market trading? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Surprisingly, around 19.8% of our viewers have subscribed. We aim to reach 5,000 subscribers as soon as possible, and your support could make a big difference. Thank you for being a part of our community.